Hey guys, welcome back to another video. In this video, I'll be talking about the Federal Reserve and its future possible moves. And this is very important, although seem complicated, it is very important because it will affect you when you want to buy a coffee, to even a point where it will affect some people on whether they want to buy a house or not. So it is very important, and this time they have some interesting news that I want to talk about. And also, I will break it into 5 simple points so I can illiterate my learnings to you as easy as possible and for you to digest it as easy as possible based off what I have digested. By the way, my content is based truly based off just entertainment. So if you want, this is not financial advice or anything. So just don't take it as it is. And I hope you enjoy this video. Let's get into it. And now my first point, which is no interest rate cuts despite the worsening economic outlook. So right now, in general, the Fed's forecast for the economy is that everything is going to get worse, like quite literally in all directions. And why is it important to note down that this specific indication of interest rates? It is important to talk about interest rates because interest rate is the thing that indirectly is able to help the Fed drives the economy because it would make borrowing easier or harder, which could affect the borrowing of people, which would cause the economy to grow or not, or would boom or not, basically. So, out of my first indicator, which is the country's economic growth. So, at December, at first they had a forecast saying that the US is probably going to have an economic growth of about 2.1% by the end of 2025. However, after the newest meeting, they have lowered that to 1.7% economic growth by the end of 2025. So that's bad. But there's more. Moving on is unemployment rate. So at first the forecast was saying that it's going to be by the end of 2025, there's going to be a 4.3% unemployment rate, which despite the fact that it has passed the 4.4% bar and it's already bad, what's worse is that it got worse. Now the forecast after the newest meeting says that there's going to be a 4.4% unemployment rate by the end of 2025. And many of you might be saying, well, it's just 0.1%, but if you compare it to the real population of the amount of people in the US, it's not just 100%. So it's not going to be only a 0.1% of a person that's going to be unemployed. There's going to be thousands of them that's going to be widely affected by this unemployment rate if this forecast is true. But it unfortunately gets worse as well. There's more. Moving on is PCE inflation, which is core inflation, which is the preferred way of inflation indication for the Fed. And they said that they had a prediction at December that by the end of 2025, core inflation is going to be at 2.5%, but not anymore. By the end of 2025, the new prediction is that core inflation is going to be at 2.8%. So that's going to grow, and it's bad. It means that inflation is going to spike again, and people are going to feel the pressure of buying groceries even more than they already have, despite the crazy egg prices recently. I mean, it has come down a little bit, but a little bit is not gonna erase the effect. It is still crazy. And what's the difference between core inflation and headline inflation is that core inflation strips out of volatile food and energy prices. So that's the difference. And if core inflation is gonna rise, it means that headline inflation is most likely gonna rise as well. And okay, so now there are so many indications that says everything's gonna go worse. But despite all of this, the Fed still decided that, okay, I'm not going to cut interest rates. And I'm gonna get into why they do this later, but right now I'm just telling you that everything is moving towards a bad direction. And despite troubling indicators, actually the Fed still wants to cut rates 2 times in 2025. What some of you might be thinking, of course they want to cut rates in 2025, right? Because unemployment rate is getting worse and economic growth is getting worse as well. Of course, there's going to cut rate, but there's also the indication that inflation is also rising. So why would they want to cut rates as well, right? So it's also troubling, but they still stand on the same perspective as last year's forecast, where they want to cut only 2 times in 2025. But they are also adopting the wait and see approach, which is basically they're going to rely on data more and they're going to react based on the next report, like that, which also gives them a little bit more flexibility in a way, instead of just fixing their actions inside a schedule. Now moving on. And now to my second point, which is market expectations for rate cuts are rising. So while the Federal Reserve is holding off on rate cuts currently, the predictions says otherwise in the near future. So after the newest Fed meeting, they have released all these bad news. The rate cut expectations has significantly increased. The rate cut expectations for May went from only 14.7% to a 22.6%. Well, don't get me wrong, I'm not saying that there's going to be a rate cut during May, because it's just a 22%, and that is way below 50% mark. But what it says here is that it definitely has an effect, and more people are definitely saying that there could be a rate cut in the future. And why do they see that? Is again, it's because of the unemployment rate and also the slowing economy in the US. Due to that fact, many people see a possible reason for the Fed to take action to solve this problem if it ever really affects the economy in a huge and bad way where everyone could feel it. So they see a huge probability that that's going to happen in the near future, and they think they want to predict that way. And also a lot of investors are keeping an eye on this, because if they do decrease rates, it's going to make borrowing cheaper, and also it's going to drive economy upwards, which also means a lot of things. And one of it is that potentially the stock market is going to start booming due to the fast innovations that is possibly going to come. And not just that, they also revised the predictions for June, which after the newest meeting, they have the predictions for a rate cut in June has went up to 66.4%. And that's really high. That's past the 50% point, which indicates there's a huge chance that there's going to be a rate cut during June, which also means that a lot of analysis believes that the first rate cut of 2025 will happen during around the mid-terms of 2025, which makes a big question of when is the second cut going to happen. But before we get there, let's just focus on May and June. Okay, now to my third point. So my third point is about how Trump's policies could possibly affect the Fed's future decisions. So, as we all know, when Donald Trump has become the president, he has made many changes in the policy. And Jerome Powell, he personally said that this is going to affect the Fed's future decisions if he were to make more changes to these specific policies. First of all, the trade policy, immigrations, fiscal policy, and also the regulation policies. These are the 4 factors that Jerome Powell personally has listed down, saying that it would affect their decisions based on how Trump move around these new policies that he has made. So, why does this matter? These matter because Trump's policy could lead to increased tariffs, increased spendings, decreased spendings, and also it could affect the labor market. And all of these, based on Jerome Powell, is a huge effect on the economy itself, making it stable or uncertain or not stable. So, Jerome Powell said that these would strongly affect the decisions they make in the future. But they also mentioned that they're going to calculate the net effects of these policies and then make a decision, but not a decision based off just one factor. What this means is that they're going to calculate the average effect, like okay, simple terms is they're going to calculate the average effect of these factors that are caused by the policies together, the average effect, which is like a crazy way to put it, but the average effects that all of these policies make, and then make a decision based on the average impact that it would make to the economy. So if the average after everything combined together is going to be bad, then they're going to make a decision on what they're going to do. But if all added together, all things seems okay, then they're not going to make anything happen just because, let's just say, maybe the labor market has spiked a little bit more. Well, if the labor market spiked, like the unemployment spiked, then that's a different story entirely, but you get what I mean. And this also means that the acknowledgement suggests that the political development is going to strongly affect the Fed's decision in adjusting the economy, which also leads to another layer to consider when you want to look at what could the Fed do in the future, which could be a little bit troublesome, but I'll try to keep you guys updated. Moving on. And now to my fourth point, which is the Fed remains agile amidst of uncertainty. So if there's one thing Jerome Powell has admitted is that they're going to remain agile. What this means is also that they're going to take action whenever they faced an unexpected situation, meaning they are flexible. But if that's not the case and there's no unexpected events that happen, then they want to let interest rate remain as high as possible until the inflation has come down to 2%. That's the original plan. But if labor market significantly weakens, then they will lower interest rates to make the economy growth boom and also at the same time help labor market. If the labor market significantly weakens. But if it doesn't, then they're going to keep interest rates higher for longer to deal with inflation. But what are they trying to say here? What Jerome Powell is trying to say here is that essentially they're in a strong position. Well, he did say they're in a strong position. He thinks that they're in a strong position because interest rates at the point where it is actually still affecting the growth of inflation and is eventually going to help inflation come down as well. They're at that point of interest rate. And at the same time, the labor market, although getting worse, it is not at a point where it is very bad. And it is not at a very bad point where interest rate is low. It is at a bad point where interest rate is kind of high. So if anything happens to the labor market, they can immediately take action on the interest rates. That's why he says that they're in a better and strong position at the moment because they can take action at any given point of time because of the current point of interest rate as well. And now to my fifth point, which is tariffs pushes inflation higher. You see, Jerome Powell directly blames the tariffs and say that tariffs are the reason that inflations are rising and is keeping them from getting to the 2% inflation point target. And they're saying that the increase in trade barrier is the direct cause of this thing and tariffs is going to make inflation worse. However, there is also a lot of analysis out there that says that no, tariffs are not the problem, and tariffs, in fact, in the long run, tariffs is actually not going to significantly affect the economy. And furthermore, tariffs are actually not the source of problem of inflation. Inflation is just caused by the natural causes of the other things, such as supply chain adjustments and technical and reduction in like technological innovation. These are the causes of inflation, not due to the fact that tariffs has been put upon other countries and other countries have put tariffs on us. That's not, to a lot of people, some other people, they say that tariffs are actually not the core effect to drive inflation or the core effect to any bad news in the long run for the US. But I personally am not sure and I cannot tell you for sure which one is or not what's the truth. So comment down below if you want to know about the other perspectives of other people on whether tariffs are actually the main effect or not the main effect of the cost. And comment down below if you want to know what people say about whether the tariffs is the cost or not the cost. So if you're curious about whether tariffs is actually not the cost, then comment down below and I'll try to make an effort to make a video about it as well. And now to my conclusion. So what does this mean for you? Well, the Fed has said that economic growth is going to slow down, unemployment rate is going to go up, and inflation will still remain a problem even to the end of 2025. And that's pretty much for sure, because if the Fed says that inflation is going to be a problem by the end of 2025, which they normally try to lowball it, then you could probably expect it to be bad to the end of 2025. But despite all of this, they still want to cut 2 times during 2025, and they still remain their target inside their forecast. And the market expectation for June for a rate cut is quite high, so keep that in mind. And also, the Fed has created a wait-and-see approach. Basically, you can expect the Fed to make decisions based off every single event that happens and or uncertainty that happens. If not, they're going to remain the way they are and go according to their plan. And also, tariffs are potentially the cause of inflation based on the Fed and potentially not based on some other people, which concludes my video. And of course, there's much more saying that, much more details regarding the uncertainty of the future of the economy. However, that will be the conclusion of it. So I hope you guys enjoyed this video. I hope you guys like and subscribe. I hope you guys continue to follow me on this journey where I grow in knowledge with you as well. And I hope to see you guys in the next one. Bye.